Ask any traditional business owner in India what matters most, and they're going to give you a one-word answer: profit. Right? So when regulators and global funds suddenly demand that companies spend millions on environmental, social, and governance frameworks, ESG for short, well, it sounds like a massive, incredibly expensive regulatory luxury. But is it really? Welcome to this explainer, where we're going to break down some seriously fascinating data to find out if that traditional mindset is actually just leaving money on the table.
Okay, let's jump right into this. The big question we're tackling today is this: does ESG actually hurt the bottom line, or is it literally the ultimate hack to making more money? We're dissecting that massive perceived trade-off between sustainability and profitability, and we want to see how the numbers actually stack up in the modern corporate landscape.
You see, the traditional view treats ESG as just an expensive, tick-box luxury, a heavy burden imposed by regulators. But the reality as we head into 2026, strong ESG data absolutely isn't a charity donation. It's a powerful financial lever that fundamentally alters how much it costs your company to raise money. It's an insider hack, and the most competitive firms out there are already using it.
Section 1. Unlocking the capital discount. How ESG lowers your borrowing costs.
So, enter the concept of the greenium. It's basically the yield discount and the subsequent interest savings that issuers realize when they issue green-labeled debt compared to identical conventional bonds. Think about how international bond markets and large institutional investors price risk today. Companies with clean, verifiable ESG profiles get access to sustainability-linked loans and green bonds with built-in interest rate discounts. Why? Because investors mathematically view them as a lower long-term risk. It's that simple.
And the actual math behind this discount? It's staggering. In advanced economies, the average greenium discount is about 2 basis points. But if you look at the Indian sovereign domestic market, that jumps to a 5.5 to 6 basis point discount. And for emerging markets on average, a massive 13 basis points. This proves that emerging market businesses can save roughly 13 basis points on their yields just by accessing green capital. This is not just some economic theory. It is a very real structural pricing advantage.
Conversely, a poor environmental record actively drives up your borrowing rates. If your business has severe environmental controversies or just a lagging ESG record, global private placements are going to hit you with a stiff risk premium. But clean, verifiable ESG data, that equals a major capital discount. You're lowering your long-term financial risk, and lenders are absolutely rewarding you for it.
Section 2, India's Green Banking Pivot. The domestic power moves changing the market.
Let's look at the State Bank of India, SBI, as our prime example of this pivot. According to their latest sustainability report, India's largest bank has set a highly aggressive mandate. They want to ensure that 7.5% to 10% of their domestic gross advances actually qualify as green by the year 2030. Think about that for a second. That is a colossal shift in capital allocation from a mainstream commercial lender.
And to fund this massive 2030 expansion, SBI is actively establishing dedicated international conduits to channel low-cost global climate finance straight into Indian corporate projects. Just look at the figures they've secured: a €150 million green facility from the KW German Development Bank, $90.5 million and $175 million lines of credit from the Asian Development Bank, plus a monumental $1 billion syndicated social loan. They are literally funneling cheaper international capital directly into domestic corporate banking.
So what does this actually mean for your treasury team? Well, it means that if a company wants access to these massive pools of cheaper green term deposits and those premier domestic corporate banking rates today, auditable sustainability metrics are your golden ticket. It's no longer just a nice-to-have PR thing. Verified ESG data is absolutely mandatory to get the best financing deals.
Section 3. Driving the valuation premium. Achieving operational outperformance.
Academic assessments of the Sensex and NSE 100 reveal a pretty fascinating, nuanced dynamic. In the short term, the compliance costs of ESG, like buying new equipment, funding employee welfare, or paying for reporting audits, they actually drag your return on assets, or ROA, down. It costs money to settle this up. But the operational efficiencies you gain eventually create a massive positive impact on ROA, and that leads to a statistically significant increase in your overall share price and firm valuation. A recent study from Hansraj College confirms this long-term view perfectly, noting that environmental and governance scores positively influence ROA and profit after tax, highlighting the importance of these components in sustainable profitability. Basically, when you cut electricity and water waste, those savings drop straight to your bottom line as increased net profit over time. The short-term pain is completely eclipsed by the long-term gain.
Beyond the direct accounting savings, there's also the hidden alpha of ESG. Companies with flawless ESG track records actively attract top-tier tech and management talent who specifically demand ethical governance. Plus, it acts as a massive competitive advantage, helping you secure incredibly lucrative multinational vendor contracts and outcompete rivals for global supply chains. It also minimizes agency costs, drastically reduces the risk of regulatory penalties, and builds deep, lasting institutional trust.
Section 4. A Profit-First ESG Strategy. The actionable blueprint for Indian promoters.
Okay, here is your 3-step profit-first roadmap. Step 1. Focus on high ROI transition targets. Start with energy efficiency, like migrating your commercial infrastructure to captive or rooftop solar. The capital expenditure pays for itself in reduced power tariffs within just a few years, which immediately generates clean data for your reports. Step 2. Clean up your governance first. Tighten your internal data controls and ensure absolute transparency. And finally, Step 3, align with local taxonomies. Build your frameworks to mirror India's evolving SEBRSR core and RBI master directions. That way, you're automatically eligible for those green bank advances as they scale up. Now, the crucial point regarding Step 2, and honestly here is a major insider tip, is that the G in ESG is very often the cheapest to fix, but it carries the absolute highest weight for investors. Tightening your board transparency, securing your cyber infrastructure, and strictly adhering to SEBI LODR rules, that is a low-cost, incredibly high-reward move that instantly elevates your risk profile in the eyes of lenders and investors.
Section 5. The verdict. ESG is how you protect your profit.
The debate of ESG versus profit, it is officially over. Today, green companies in India aren't just saving the planet. They are securing the absolute cheapest capital and outcompeting the rest of the market. The rules of capital have permanently changed, folks. If you are ignoring ESG or treating it just as some corporate hype, you are simply leaving money on the table and exposing your firm to totally unnecessary risk premiums.
So I want to hear from you. Is your business looking into green finance options? Or do you still think it's mostly corporate hype? Let me know your thoughts in the comments below. And be sure to share this explainer with your corporate strategy, treasury, and finance teams. They really need to see this data. Thanks for joining me on this deep dive. Keep learning, and I'll catch you in the next one.